of new economic data which showed that here in the U.S. the inflation rate fell to its lowest level in over 3 years in June, boosting the case for the Fed to cut rates later this year. And moving on to today's interview, the S&P 500 marked a 37th record close this year after topping 5,600 for the first time. The tech-heavy NASDAQ composite was higher for the 7th straight session as well. Now, tech's biggest names continue to rise, powering the gains of the broader market, with AI darlings NVIDIA, Apple, Microsoft, and Google adding over 1% in the previous session. This morning, I'm joined by Ross Givens, head trader and educator at Traders Agency. Ross, thank you so much for joining me today. So we got the CPI data, and of course we're looking forward to PPI figures as well. But between the latest inflation data and latest jobs report combined with Powell's testimony, what can we expect from the central bank?
Well, I think the market is telling us that Wall Street believes they're going to start cutting. And I think Powell has wanted to cut for a while. But, you know, when you cause record inflation with your crazy money printing, you don't want to embarrass yourself again by cutting too early. So I think they're just looking for any excuse to start cutting. They likely will. If we ended up getting 2 cuts in 2024, that'd be huge for the market because we're only expecting 1. But this has been a long time coming, and you know, the market is speaking, and we're going higher, and you know, we're extremely bullish on the markets right now.
And Ross, all eyes have been on Washington, D.C. this week with Congress back in session, Powell testifying, and the NATO summit taking place as well, all in a presidential election year. So how are you assessing the overall macro landscape as we stand right now?
Well, again, I mean, the market tends to know best. We know that it's a discounting mechanism and all known information is priced in. And there's a lot of people with a lot of money that spend a lot of that money to try to predict this stuff pretty well. And unless I'm seeing something you're not, I mean, the market is saying Biden is out, Trump's going to win in a landslide. I think that's very good for markets, regardless of your political stance. You know, cutting regulation, pressuring to cut interest rates, pushing for job growth and economic growth. So, you know, nothing is guaranteed, of course. We could see anything happen over the next couple of weeks. But really, once you get past the DNC convention, if they really lock in Biden as their candidate, it would be very shocking not to see a Trump presidency coming in. And I think that's exactly what the markets want, especially the energy space and banking sector and a lot of these heavily regulated areas.
Well, we have a lot to keep our eyes on when it comes to the presidential election with the conventions coming up later this summer. But when it comes to the broader market, we continue to see record highs for the major averages. The highs are being achieved with fewer stocks advancing, the unweighted S&P 500 hitting a series of lower highs as the weighted index continues to make higher highs. So do you have concerns when it comes to market risk?
Well, of course, it is definitely thinner breadth than usual, meaning, you know, as you perfectly said there, you know, fewer stocks participating in that. Now, the NASDAQ, on the other hand, I was just looking at the equal weighted index. It actually is making new highs today. It's not as extended as the weighted NASDAQ, but it is making new highs. But this is not unprecedented. You know, you go back to the mid-90s when we had the tech bubble. It was very similar. We had narrow breadth. We still had a raging bull market for several years. Now, the bubble burst on the dot-com side, just like eventually the bubble will burst on this AI bubble and some of the semiconductors. I think NVIDIA will see a 50+% decline somewhere in the next couple of years. But, you know, until then, ride the wave. I mean, it's not as if it's super thin. It's a small handful of stocks. We are seeing the equal-weighted indexes making new all-time highs. And look, when it comes to evaluating bull and bear markets, undeniably, we've never seen a bull market peak when it's going up on bad news. You know, what you want to watch out for when a bull market has been going up for a while, when it starts coming down on good news, that's when you're getting to the end. Same thing with a bear. You know, when a bear market is coming, like we had in 2022, when it starts going up on bad news, it's usually the turning point. So when you look at what we have right now, we're expecting 6 rate cuts. We're now hoping to get 1. Inflation, this last report was pretty good for the last 30 days, but it's still much higher than we thought it'd be right here. GDP has not grown as much as expected, yet we are marching to new all-time highs. So it is really hard to imagine this bull market stopping while it's rallying on poor news. We are still very early in those stages. We're not too much above peak 2021 prices. Personally, I think we have several years of this bull market still left to go. So you're right. You want to be selective. You want to focus on those areas. We like semis. We like shipping. We like nuclear. Some of those areas right now better than others. I wouldn't touch solar stocks or anything like that. But yeah, we're very bullish. And I think if you're not here, you're missing a great opportunity to make some money.
And Ross, as you mentioned, after 18 months of hyping up AI and its potential impact on both corporate profits as well as human productivity, there is some skepticism there. Earnings season is about to kick off, and we're seeing interesting price action when it comes to airlines. Delta down this morning by over 4%, and PepsiCo is also down as well. But when it comes to the earnings season, what are you watching out for?
Well, we're just looking for surprises on the downside. It's especially in the AI group, they have to beat to keep going. They don't need to just meet expectations. They really need to beat. That's what we've seen for the last several quarters in a row. And as soon as that slows down, what would scare me, at least for a short-term pullback or seeing the market sentiment shift or rotate to a different sector, would be any kind of weakness in the AI sector. All eyes, as you know, are on NVIDIA or on Supermicro or on Apple or on Google. If they show a chink in that armor, there's huge growth expectations priced into NVIDIA and some of the others. And as soon as they come up short, and that could be, look, we expect 400% earnings growth, and they only put up 350. It's still a huge number for a $1 trillion company, but it's so much growth is priced in there. If we start seeing weakness, missing expectations, that could be the bubble beginning to burst in the AI space. Now, I think even if that happens, you're still going to see growth in other areas. You're still going to see the bull market continue after a short-term pullback. It's not as if this whole thing is riding on AI, but that's really what we're looking for. I think the NVIDIAs and some of the others are getting long in the tooth, and we're looking for any signals that run might finally be over.
Well, Ross, as always, thank you so much for joining me. As we head into the summer months, we have a lot to keep our eyes on. So, as always, thanks for all of your insights.
Always a pleasure. Thanks for having me, Remy.